I'm Darius McDermott of Chelsea Financial Services. Today I'm with Robert Baltzer, co-manager of the Baillie Gifford High Yield Bond Fund. Robert, why should people invest in high yield bonds?
A high yield bond fund is a great way to get exposure to an asset class that over the long term has been very rewarding for investors, and it's pretty difficult to invest directly in that asset class. So the high yield in the name refers to the high rate of interest that certain riskier companies have to pay to borrow in the bond market. And that is necessary to cover the losses that do occur from time to time. But in a well-diversified portfolio and over the long term, those inevitable individual losses are covered by the income and the capital gains from the balance of the portfolio. And investors have been very well paid over time to take that small risk of non-payment.
And the high yield index had a very difficult time late in 2015. Did that present opportunities, or did that just raise further concerns for you?
So we can trace that move back actually to the middle of 2014 when high yield bond prices started to fall gradually and yields rise just a little bit. And there have been some more dramatic moments around the turn of the year, as you mentioned. Actually, a lot of that has been reversed more recently, so some of the things that investors have been concerned about, those fears have perhaps dissipated, or perhaps central bankers have helped them to feel better about the world. Again, as we look at the world today, we're actually reasonably happy that valuations are reasonable, particularly in the context of very low government bond yields. There are always things to worry about, be it markets, economies, politics, and today is no different to times in the past.
And your fund can invest anywhere in the globe. I know you've got a UK and European focus. Where geographically are you seeing the best opportunities in high yield bonds at the moment?
Well, you're right, we are Europe focused, but we do have that flexibility to invest in the US and indeed elsewhere in the world. Over the last 3 years, the biggest change in the disposition of the assets in the fund has been an increase in our North American holdings. So they've nearly doubled over the last 3 years to be about 1 in 6 of our holdings today. And the reason for that is just the quality of the businesses that we find in the US, the fact that the risks involved there are different in some respects to our core European holdings. And in some cases, we find that the quality of disclosure and governance is quite a lot better. It can be quite patchy in Europe. There are good examples, but some bad examples, and monitoring those European investments can be a bit trickier. One of the things we've been keen to avoid is the more speculative parts of the market, or those with refinancing risks in the near term. So we've been avoiding the US energy sector, for example, or the more distressed parts of the European market. So we think there's a lot of opportunity, lots to go for among the group of companies that is much more likely to return our investors' capital.
Robert, thank you very much.
Thank you.